my intro earlier, I'm an investor at episode 1. We do B2B software venture capital, and we invest at seed stage, check size between $250,000 and $3 million in companies that have the potential to be worth hundreds of millions or ideally billions of pounds, so operating in huge markets. That's sort of a brief recap. Yeah, it's a good question. We're a generalist fund, so we're happy to look at anything that seems interesting, and we have, naturally we have sort of more expertise in certain areas, but actually if you look at our portfolio, by this stage we have pushing on 40 companies, each of which we've had to do deep sector dives and get familiar with the sector, and the way that we usually get comfortable with making an investment in a sector that we're not used to is we'll talk to a lot of experts. Honestly, you guys, the founders, are the best source of knowledge for us, so we'll talk to obviously you guys and also companies operating in the same space. So yeah, generalist fund, no particular sector focus at the moment. So it's a good question, and it's there's no hard answer, but it requires some sort of self-segmentation on your part. So if I talk about the sort of two extremes of the spectrum, it is a spectrum, then hopefully you guys on an individual basis can work out sort of where you sit. So on one end of the spectrum, there are really deep tech businesses. These are ones where it's an incredibly difficult technical challenge. The kind of thing where when we're doing diligence on the company, we speak to people in the industry and say, hey, what about this? And they say, well, if they can do it, this is going to be incredible, but we don't think they can. So that's the sort of deep end of the scale. An example of that from our portfolio would be Cloud NC, which is they're automating the machining of metal parts using CNC machines, which at the moment is an incredibly human-intensive process, very inefficient because humans' brains aren't capable of finding the optimal route to cut a piece of metal, believe it or not. And it's incredibly difficult optimizations that they're building, and have raised so far £25 million plus, and have very, very low revenues, kind of well below that 1 million annual revenue. Actually, probably pushing up over that now, but until recently, they were still under £1 million annual revenue. But the reason that that's possible to raise such a lot of money despite lack of revenues is because automating metal parts machining, ultimately is an absolutely huge prize. So we backed a couple of guys who we believed were the right people to execute on this grand vision. And that was enough to get us comfortable investing before they had revenues. So that's the sort of very deep tech end of the scale. And then on the other end, you have much more execution focused businesses where perhaps you're tech enabled, but you're not particularly developing anything proprietary. You might be using off the shelf APIs and integrations and software to perhaps build a marketplace business. So the technology has been around for a while, and in those cases we're really backing the founder's ability to execute on the plan, and therefore we would likely want to see some considerable revenues. So perhaps 20,000 a month is very ballpark. There really is no firm figure, but if you're right in that end of the spectrum, then that is a sort of ballpark that many investors will kind of start to think your company is looking really interesting. So the second part of the question was, so that's the commercial validation part of the question, and then what sort of time frame post investment would you expect a business to convert that interest into £1 million of annual revenue? So this is our big question that our challenge as episode 1 is to get companies to that level, or to considerable revenues as soon as possible. what that means is that they can raise a really good Series A from a top tier investor. So this is really our bread and butter. We're looking to invest very early on when they don't have many revenues, and we're looking to encourage them and help them to get to, if it's appropriate, to get to considerable revenues as soon as possible, so that they can raise more money as soon as possible, which makes us look like we're doing our job properly. So in terms of a time frame, it usually also it's worth bearing in mind that that £1 million revenue mark is really, it is a good ballpark, but like I was saying earlier, it really depends on what type of business you are. And actually, if you speak to most top tier Series A investors, they would say that, you know, they'll look at any business regardless of revenue. It just has to be compelling idea, huge market, amazing founders, are really the three pillars. So I would say I'm actually going to answer the question time frame from seed to Series A, rather than putting a hard sort of £1 million tag on the Series A. And we would hope for that to be sort of 18 months. And for a really execution focused business, maybe that's the marketplace. That might be 18 months until they reach about 1 million of annual recurring revenue. So if I think about our portfolio, the marketplace is in that. That sort of seems like a very ballpark, but reasonable ballpark estimate of sort of how long it might take to get to that £1 million revenue mark. So that's yeah, I mean, so there's no silver bullet, but the three pillars which I sort of said earlier is it's got to be an interesting idea, it's got to be a huge market, and the founders have to be extremely compelling. So those are, so the interesting idea part is because we're going to be coming along to board meetings for the next 10 years, and we want to enjoy those board meetings. So we also have to be, we have to be able to get behind what you guys are doing, find it interesting, and also clearly think it's a commercially viable idea, and think that it makes sense and it's something that people need to have, not just that it's something that's nice for them to have. So the next thing is the huge market. So we have to be confident that if you guys do execute really well on your plan that you've outlined and started executing on, then the appetite is there from the market for you to get to revenues which would warrant your business being enormous. So for us, that means, we're looking for exits in the multi-hundreds of millions or billions. And what gets us comfortable with that usually is to think that in the UK only, because that's, most of the companies we invest in start off in the UK market, and it acts as a reasonable proxy for the rest of the world. In the UK market alone, if you got to 100% market share and we're charging sort of a reasonable figure to your clients, we would want you to be able to get to 100 million of revenue. It's interesting looking at people's decks because there are figures thrown all over it. And they range anywhere from hundreds of millions or tens of millions to tens of billions. And usually once you do a little bit more digging, you actually realize that figure's kind of way off. But a useful figure for us to know is if you got 100% market share, charging your target customers a reasonable estimation of your sort of target customers, the amount that you want to charge them, would you be at £100 million revenue? So that's the market sizing, and then the founders is totally case by case basis. Are we sat opposite you in the pitch thinking, wow, we have to give this person money? Do they get us excited about the vision? Sort of top tip is actually to talk a little bit philosophically about your vision. What will the world look like once you've made your mark on it, and once your business is prolific? We want to that's the sort of thing that just gets us excited. Thinking, can you still hear me, by the way? The internet connection.
Yeah.
Great. not just talking to myself. So yeah, we need to just kind of get that tingly feeling when we're sat opposite you, thinking this person just wants to build an enormous business, will stop at nothing to build that business, and has demonstrated, perhaps you can do that with war stories in your current position, or you can talk about stories from your career so far or outside of your career so far that demonstrates your resilience, your drive, motivation, all of those good things. So I think those are sort of the key things that we look for, and it is very much a feeling as well as a science. So I think it's important to remember that if you get rejected by a VC, that's not to be taken personally. The very, very best companies all over the world get rejected by the very best VCs, and you only have to look as far as a company like Airbnb, who tons of great VCs said no to at the time, and of course are now kicking themselves. What I'm trying to say is that every VC has what they call an anti-portfolio, and they've all said no to great companies, but if you persevere, there's likely to be an investor who will share your vision, and that you will you'll have a connection with, and be able to secure an investment from them. Yeah, it's a good question. So I mean, we don't have a problem with single founder companies per se. So I think the thing that does matter is the team, particularly the early team, incentivized to build a huge business and to execute on the vision. So I think if you're a single founder, that's not a problem at all in itself. But you need to be able to demonstrate that you can hire the very best people in order to build the team, attract the right talent going forwards, and often the very best people will only be attracted to a company if they are offered considerable co-founder type equity stakes in the business. So if you are a single founder, you certainly need to be open to giving away reasonable amounts of equity to your early team, because every early team member is worth kind of a huge amount to the ongoing prospects of your business. I've sort of already answered that. The milestones are specific to what type of business you are and where you fall on that deep tech to execution focused spectrum. So I actually won't go into that too much more. Very briefly, we want to see a number of data points of, you may have raised, for example, so we're investing at seed stage. Typically the companies we invest in have raised an angel round or a pre-seed round. What we want to hear is the story of how you've got to where you are today. So 2 years ago, we had an idea to do this. We raised an angel round because we'd shown this with an MVP that we built. With that 200K pre-seed round or angel round, we proved this, and this. And you can see that we're amazing at executing because we did this so this KPI quickly. And therefore, it's only right that you should invest £1 million because we've proven we can execute, and we're going to continue to do the same according to the plan we've laid out here, getting us to a really good Series A. So that's probably the sort of story that you're going to be telling in a seed stage pitch. And the milestones are, I think, largely actually common sense based on what you have achieved, and pick out the key things that you think will impress an investor. I mean, the key thing through all of this is to put yourselves repeatedly in the shoes of the investor, and think about what's going to put them off, what's going to hook them, and what you can do to address both of those things and reduce the number of put-offs and increase the number of hooks, or increase the prominence of the hooks. And one, I think so a lot of the sort of dust has settled now. The first few weeks, first maybe couple of months, was very much kind of, okay, what's happening here? Let's wait, let's not invest. But we had a few investments that were, we had term sheets out and we closed both of them. And we've actually now, the dust has sort of settled, and we've, we're still taking lots of first meetings with founders. And we've done our first investment, closed it yesterday or end of last week, into a company that we've never met the founders for. It's a £500,000 check, so it's a little bit smaller than our average check, which helped its case. So what also helped is that we know very well the fund who's co-leading with us, and they had met the founders. So there were some mitigating circumstances, I guess. But yeah, I think the general mood in the market now is that we have to move forwards. VC has to move forwards. We have money to invest. The money from our investors hasn't gone anywhere, and so we plan to deploy that. The thing that has changed is, we are planning, and it seems to again be the sort of mood of the market, and all of the VCs that I'm talking to seem to reflect this. We are probably going to do fewer investments over the next 6 to 9 months, whereas we might have done perhaps 7 or something like that. We might now do 3 or 4, something like that. So essentially what that means is that the bar has been raised, for the sake a higher bar. You have to be one of the companies that we meet and just think we have to give these people money. So I think that is probably the case, but again, what that kind of translates to is just an increased level of persistence from founders, because again, there probably is an investor out there who will invest. It's just a question of seeking them out. So I think that sort of answers the question. Our appetite certainly went away, but our appetite has certainly come back. And in terms of what our appetite looks like, it's more for companies that are probably quite earlier stage than we're used to investing, or than our average investment is. So reason for that is because there's likely with those companies going to be a lot of tech development and product of them, and focusing on revenues immediately, and going out immediately for those enterprise sales. Many of those enterprises have had their budget squeezed and are stopping spending. So those are the companies that are disadvantaged. The ones that are possibly even advantaged are the really early stage ones with lots of product build and tech build ahead of them. The reason they're possibly advantaged is because there may be more tech people available, tech talent, and that might be available at lower cost. We haven't really seen whether that's the case yet. Most of our portfolio companies haven't seen that their hiring has become much easier yet, but there's likely to be a delay on that. So hopefully, there might, I'm not going to say hopefully actually, because these people have lost jobs, but that could be a sort of unexpected benefit to the startup ecosystem.